Okay, I'm very excited to have on the Goldstein on Gelt Show, Dana Anspach, who is, like me, a CFP. She's also been in the business around 20-something years like me, so we have a lot in common. She also teaches a great deal about retirement planning. In fact, that's where I discovered Dana. I read an article that she wrote called Where Academia Fails in Real-World Retirement. Real pleasure to have you.
Thanks, Doug. It's great to be on the show.
So, a lot of people, and I guess I'm guilty of this as well, like to quote academic research when they teach investors about how to invest. But you're saying that there is some level of failure or problem in doing that. How come?
Well, when you look at the academic research that's out there, it uses assumptions. I mean, that's all we have to use when we're projecting the future. But a lot of those assumptions don't apply when you get down to the individual level. And a lot of the research will leave out things like the impact of taxes or the effect of inflation or the effect of investment fees. So depending on how the research study was conducted, it may not take into account the real life factors that each retiree has to deal with.
Why do you think they leave this stuff out?
Well, I think the models just aren't capable of incorporating all of the relevant factors at the same time. And you also have, the academic scholarly types of people are focused on a particular topic that they want to take a deep dive on. Whereas us as financial planners have to look holistically at the client's entire situation, and they may have accounts in IRAs and Roth IRAs and stocks outside, and we have to pull all of that together. And an academic person looking at a particular niche topic doesn't have to do that, nor have they ever had to do that before. So I just don't think they think the same way as someone who's working with a family and their household finances.
I think that's a great point. One of the things that a lot of people like to believe is like you said, they'll read some academic study and they'll say, oh, well, the stock market makes 10% or 12% a year. And all of a sudden they assume that. And then they don't even realize the fact that most investors do less than half that on their investing. And it's not because the academic studies are wrong. It's just because the information that people are drawing from those studies doesn't accurately depict what real life is like.
It does not accurately depict what real life is like. And, those averages are perfect. 50% of the time, you're going to see a result better than average, but 50% of the time, you're going to see a result worse than average. And as a retiree, you need to know your plan's going to work, even if you get that below average investment result. And those are the types of factors I don't always see covered thoroughly in the academic research. They deliver rules that are great as a broad general overview, but not rules that as an individual family you can take and just apply blindly to your situation.
So how much attention do you think the individual investor should pay to this kind of academic research when putting together a long-term plan?
Well, I think if you're just starting out, it can give you an overview of what to expect. For example, there's the 4% rule, which says you can expect to draw out about 4% of your financial assets in retirement and reasonably think that money would last 30 years. So you could say, all right, if I have $100,000, I could expect to draw about $4,000 a year out for every $100,000 of capital. That's a very general rule of thumb. What it doesn't take into account is income taxes. Let's say that $100,000 is in an IRA or 401k plan. Depending on your tax bracket, a third of it, or even 40 or up to 50% of that may have to go right to pay income taxes when you draw it out. So that $4,000 may only deliver $2,000 of cash flow. So that's the differentiation between using that broad rule of thumb as a big picture starting place, and then figuring out, wait a second, how does that actually apply to my situation and what types of accounts I have?
So it sounds like you're against using rules of thumb, yeah?
I'm against them. Yeah, I think I'm against them on an individual level. Yes, I do think they provide valuable information from a very big picture standpoint.
So a starting point, one of the other, you mentioned the 4% rule. One of the other common ones that people like to talk about is the percentage of your portfolio that you should have in fixed income should be your age. So someone who's 60% would have a 60% allocation to fixed income and 40% to equities or stocks. Does that type of thing ring to you, or do you say, throw that out the window? You need a real plan.
I would say throw that out the window. I've seen these rules, and they have done studies that take that 100 minus your age allocation rule, and then they match that up against with what's called a standard 60-40, 60% stocks, 40% bonds rebalanced. And then they will compare that against something where you are creating what's called a rising equity glide path, where you actually start with a little bit more in stocks and then, or actually a little bit more in bonds. And then as you age, you may end up with more in stocks. And depending on market conditions, each approach performs differently. But some approaches do provide more certainty, and that's what you want in retirement. You need to know if you get the worst market conditions, you're still going to be okay. And some approaches aren't designed for that. They work well in good market conditions, but they don't work as well in poor ones.
Mm-hmm. We're talking with Dana Anspach, who is a certified financial planner with Sensible Money. She's also written a number of books. She is a writer with MarketWatch as well as on About.com. She's been talking to us about some of the problems that people have looking at academic studies on investing or just taking rules of thumb. So, and I'm with you, Dana, is that I think people really do need a plan, and they need to develop a plan and work it. But one of the issues that a lot of people have is, like with their will, they'll write their will, but they won't sign it. Similarly, they will prepare a financial plan, but either they don't follow it or they don't follow up with it. Do you think that people tend to ignore them after they do them?
Well, one, if they've done one to start with, at least they've done one. Because so much of the population, okay. So many people don't. But yeah, it's not a one-time event. Planning is an ongoing process. I've heard the analogy, if you're flying from, New York City to LA, the plane is rarely actually on course. It's a series of course corrections. And financial planning works exactly the same way. You draw out a general outline of how much you're going to need to save and how much you can withdraw in retirement, but those numbers need to be refined each year based on changing tax rules, based on your changing spending needs, based on life events that occur. Sometimes you're forced to retire earlier, or you have the opportunity to work a little longer. So it's something that needs to be constantly refined and updated.
Well, let's talk about in the retirement years, which is really your specialty. And I think one of the areas that a lot of people miss is that there are still a lot of taxes to be dealt with when they retire. What sort of tax considerations do you think people need to really think about?
Well, the biggest tax consideration is that when you have a lot of money inside qualified retirement accounts, things like IRAs, 401ks, 403b plans, every dollar you take out shows up as taxable income on your tax return. And once you reach age 70 and a half, you are required to take a minimum amount out each year. And the proportion you have to take out goes up each year that you get older. And that can create a deferred tax bomb where people don't realize that once they have to start taking more and more out of those accounts, it has an impact on other areas of their tax return. For example, if they're collecting Social Security, suddenly they're paying more taxes on their Social Security because of this other income that's showing up on their tax return. And when you look at all of that out and project it out over a retiree's life expectancy, sometimes there are things you can do in the early years of retirement between age 60 and 70, Roth IRA conversions or drawing out of IRA accounts earlier rather than waiting until 70, that can have a positive impact. People don't look at that. They just look at how can I save the most this year, which sometimes hurts you over the long term.
You mentioned taxation on Social Security. Can you explain how that works?
I can explain it very broadly. So,
okay, in broad terms, right?
Yeah, there's a complex formula that is used, but up to 85% of your Social Security benefits can be taxed. And it depends on what other sources of income show up on your tax return. So if you have a lot of other income, and your other income exceeds some basic threshold amounts, which are about $24,000 of other income for singles, and it's about $32,000 for marrieds. Well, if it exceeds those threshold amounts, then anywhere from 0 to 85% of your Social Security can be taxed, and it's a formula that determines the final amount. So some people might only pay tax on 10% of the benefits received, some on 50, some on 75. Most people who have pension income or large IRA withdrawals are going to see that their Social Security, up to 85% of it is taxable.
Right. Again, that doesn't mean that they pay 85% tax on it. It just means that 85% of it is subject to tax.
Correct.
Just to clarify the point. And one thing also for people who are listening in Israel, because a lot of our Goldstein on Gelt listeners do listen from Israel, is that because of the treaty between the U.S. and Israel, if you live in Israel and you're collecting U.S. Social Security, no matter how much you earn in America, you're not going to have to pay tax on the Social Security either to Israel or to the United States. So it's a benefit, and it goes both ways for Israelis who move back to the U.S. But of course, we don't give tax advice on this show. And Dana, unfortunately, we're just about out of time, but I know there's a lot of great information that you share with people. Maybe in the last few seconds, you could just tell us, how can people follow you and follow your work?
The best way would be to do a Google search for Money Over 55. So I write for About.com as their Money Over 55 expert. And if you just search on that phrase, you'll find a lot of my content and a free weekly newsletter that you can sign up for.
Great. And we will put a link to that at the show notes of today's show at goldsteinongelt.com. Dana Anspach, thanks so much for your time.
Great. Thanks, Doug.
You are listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.